Good afternoon to everyone. I'm a partner at VWV in the corporate team. My day job is negotiating and running corporate deals, mainly in the SME sector, both on the buy side, on the sell side, and for funders who are investing in companies. Daniel, that's me.
Yeah, I'm Daniel Shear. I'm a partner at BKL, Chartered Accountants. I'm the corporate finance partner, and similarly, I advise clients on buying and selling businesses, typically in the range of £1 to £50 million. Very quick apology for having the corporate logo in the background. I'm actually working from home today, and there's in my study there's two spotlights which shine right behind me, and people have commented that they feel like they're under interrogation. So I didn't want anyone to feel like that, so that's why I've got the corporate logo on. But at least I've adhered to the home dress sense today.
I, unlike Daniel, had to come into the office, hence the jacket. My broadband was something that I couldn't trust at the moment, but I have a visit from Openreach tomorrow, so I'm hoping all will be solved. So very much this is an interactive discussion between Daniel and I on this. So what we're really going to do today is just talk about doing deals in 2021 at the moment with the background of coronavirus, and actually reassuring to know that there's not really that much change, and that deals very much can be done and are being done, and with some planning, because I think that's essential always, but particularly when things sometimes are slightly more challenging in getting a transaction done, that's really important. Going to be reminding everyone of how a deal fits together, just run through the basic process, and finishing off with some of the practicalities that we're finding at the current time. So next slide, please, Emma. We thought it would be useful first to pause for a moment and look at the last year, and then consider the current landscape that we're in. I was going to ask you, Daniel, really, what have you found? What was the what are the themes over the last year?
In our experience, it's been a really interesting year. We thought that the sort of M&A would fall off the end of a cliff, if you like, at the sort of maybe this time, late March last year, when we went into the first lockdown. We thought that's it. There's not going to be any corporate transactions taking place. And actually, we were pleasantly surprised to see that wasn't the case. Personally, we got instructed on three transactions very soon after the lockdown started. Two of them, in fact, all within 2 days of each other in August. Two of those three completed and one aborted. And the aborted deal was nothing to do with the restrictions due to the lockdown or anything. It was for other reasons. So we're sort of delighted, really, that transactions are still taking place, and people that I speak to are saying exactly the same thing. Transactions are certainly taking longer, particularly if bank debt is involved, but transactions are still happening. Is that also what you're seeing, Richard?
Yeah, very much so. I mean, it was a big shock to the markets when everyone went into the first lockdown in Q2 last year, and we found it very much like what I read other people's experiences to be. I think that Q3 over Q2 was up nearly 200% in terms of deals, and from our perspective, it was just a case of there being a stop in those during the sort of mid-late summer. All bar one of the deals that I was working on and came back on, and we completed those in either the late summer or very early autumn. Obviously, it depended on the sector, and I had one in the travel industry, which obviously hasn't moved back yet, but that's a very strong company, and I'm really hoping that that once things move again, that will come back on stream. So yes, it was that shock, and then things coming back to be to be more like we would expect it to be. And what we do a lot of as a firm is in the education sector and schools, and that followed the same pattern, really. And part of it was a difficulty in people being able to actually see the businesses in action. So yeah, a similar thing really, Dan, I think. And of course, always extremely relevant in any deal or in any transaction landscape is tax. So what's going on with tax? I know we've all got to pay for what's been happening, unfortunately.
Yes, and well, it's probably worth going back very briefly to sometime last summer or autumn. Rishi Sunak asked the Office of Tax Implications to review capital gains tax in its entirety, and they reported back late last year, and their headlines well, sorry, their findings were misrepresented somewhat in the press, where there were headlines saying things like capital gains tax rates to be equalised with income tax rates, and that's not quite what they said. Certainly, there's no doubt that the revenue have a hell of a lot of money to pay, 300 billion just for the everything they've provided for the lockdown so far, and they need to raise the money from somewhere. And so that it's inevitable that taxes in some shape and form will go up at some stage. Because of the review of capital gains tax, everyone initially assumed that in the next budget, which is 3rd of March, that capital gains tax would be raised at that date. And some people have been rushing deals to complete deals before that deadline. The thinking on the street now seems to be that now is not the time to raise taxes, and that it would actually have an adverse effect. Now, I don't know, I don't have any hotline to Mr. Sunak, so I really, it's crystal ball gazing here, but most people are thinking that whilst it's inevitable there will be raises of taxes, and in particular capital gains taxes at some stage, it's probably more likely later this year rather than now. Of course, don't take my word for it. Apologies if taxes do go up on the 3rd of March, but that's what the current wisdom seems to be suggesting.
And wider taxes, inheritance tax. What's your very quick view on those sorts of things?
Yeah, look, I think it's inevitable. As I said, there's a hell of a lot of money that needs to be raised and to pay for everything that's happened in the last year. And I think it's inevitable that taxes will go up in some shape or form. I think it's going to be very unpopular to raise the headline rate of income tax, for example. Putting an extra 1% on income tax up to 21 and 41 and 46% is easy money, but very unpopular for a government to do with 3 years or whatever it is to the next election. So there are other ways that they can raise more money, and tinkering with things like some of the exemptions to capital gains tax and whatever, whilst it doesn't raise so much money for the revenue, are probably easier wins and sort of lower hanging fruit. So where all the taxes will come, whether there'll be some kind of wealth tax or whatever, who knows? But I think some tax rises are inevitable.
The reason I mentioned inheritance tax was obviously one sells a business and has cash instead of a business asset, and that's a way in which some people, if they're not wary, can actually get quite caught out from a tax perspective. So, okay, thanks, Dan. That's helpful. So next slide, please, Emma. So let's assume that I want to sell, Dan. Clearly, I need a buyer to be able to sell. So how do I go about that? Who's out there, and what will reel them in?
Yeah. Well, I mean, really, the 3 points I put on this slide actually answer that question fairly succinctly, I think. The way to find a buyer is pretty much the same as it always was. You'd engage someone such as a corporate financer, such as myself, to go and find a buyer if you haven't already found one yourself. And the way we would do that would be the same as we always did. We'd do market research to find the people that are interested and acquisitive in that particular industry. We'd consider whether it would be of interest to private equity ownership, or just to a sort of family office type ownership. But we'd go about finding the buyer the same way as we always would. Obviously, in the current environment, cash-rich buyers are preferable. I did mention briefly before that the banks are taking a lot longer because of everything that's happened, and because of the uncertainty of earnings for so many businesses during the restrictions and the pandemic. Bank debt is certainly taking a lot longer than it always did. So cash-rich buyers are preferable. Well, that gives a slight advantage at the moment to to private equity houses and other investment firms who have got a lot of dry powder. They're sitting on a lot of cash, which they're finding more difficult to invest, and they're very, very keen to invest it. So you know, it makes them good buys, albeit they don't necessarily have the industry requirement, if you like, that a market buyer might have. But yeah, we go about it the same way. Once you found the buyer, once you're trying to attract the buyer, the obvious difficulty at the moment is site visits. In the old days, of course, you'd engage with buyers and you'd invite a few of them round to look at your operations, and that's going to be very difficult in the current environment. But you know, we've still got Zoom calls and various other ways of showing people around, and you know, as we both said before, deals are still happening.
Yeah, just using the education example, one of my colleagues was telling me that because there's a lot of overseas buyers, investors wanting to buy into independent schools, that is a big obstacle. But not only would one need to deal with local lockdown, but obviously international travel is a very difficult thing as well at the moment, and also with the double whammy of schools not being open, very hard to see, you know, that business in operation. So I absolutely agree, that is a big issue. It's also a big issue in people businesses, consultancies, businesses like yours and mine. There are opportunities for consolidation, for merger, but actually doing that without people who are going to be working very closely together, meeting and really getting to know each other, it does present challenges. And although Zoom and the other virtual meeting room media are really useful, there's nothing quite like meeting people person to person. So I agree, that is an obstacle. Okay, next slide, please, Emma. Dan, so again, to really one for you rather than me. Valuations. What are the pinch points here, and how are we looking?
Yeah, so this has really been quite interesting. A lot of people are saying what's happened to valuations since the first lockdown, and you know, which direction have they gone? And lots of people expected valuations to sort of fall off the edge of a cliff, and it doesn't appear to be the case. I think it's very important to stress, first of all, that there isn't a huge amount of data. As we both said before, there weren't many deals in Q2 of last year, in April, May, June, because it was just at the very beginning of the first lockdown. And a lot of the data from sort of H2, as it were, the second half of last year, is only just coming in now. So we don't have a huge amount of data yet. But most people are saying, and certainly it's my experience of the deals that I'm working on, that actually valuations haven't fallen as a result of anything that's happened. If earnings are going down because of the pandemic, then maybe the sort of you know, the EBITDA that is being multiplied, if you like, might be adjusted, but the valuation multiple itself doesn't seem to be affected so much. I've put a couple of examples up on the screen. The PCPI is the Private Company Price Index, which is run by BDO, and Mark to Market, who are a provider of M&A information, have their all cap index. And both of those are tracking private company deals that have taken place. And the PCPL one, I've compared Q1 to Q3, and as you can see, it's gone up. And similarly, the Mark to Market one, I've compared their April index to their December index, and again, it's gone up. Now, that doesn't necessarily mean that the average, that all multiples have gone up. This is an average, and I think what is definitely true is that some of the lower multiple deals haven't happened last year. They're going to be, by definition, less attractive businesses in less attractive industries like retail and travel and so on. And because of everything, those deals haven't happened, which is probably artificially inflated the average, because of what has been left is the sexier companies, if you like, the ones attracting higher multiples. So I don't think we should read into it that the deal valuations actually increased, but certainly the data that's out there, and it very much supports my own personal experience, is that valuations have held up and haven't really been massively affected by the pandemic.
Yeah, and I think you make the right point that it depends on the business, doesn't it? Really. So the deal that kept me mainly busy over the summer was in cloud computing, and obviously massive demand for those sorts of services, and that business held up very well in terms of its valuation, and hence the reason that it moved forward and got done.
Yeah,
So
and it's exactly the same with us. I mean, we're working on a deal at the moment in software as a service, very in demand product that they supply, and that's going at a quite a large multiple that's comparable with the mark-to-market ones that are down there. And again, the valuation hasn't been affected at all.
are you finding deals more now where there are sellers keeping a stake in the business going forward, sort of elevator type deal?
Some. It depends on the industry, I think. We're actually been involved in quite a few disposals to employee ownership, going to the sort of John Lewis model, if you like, which is something that the government is very keen to promote. And there are significant tax breaks for sellers who are selling to employee ownership. If a majority stake of a company is sold to an employee ownership trust, and actually there's no capital gains tax at all on the sellers. So we are seeing some of those go through, particularly before 3rd of March. And what we are finding there is that they only need to sell a majority stake, and we are finding that typically sellers there are keeping back anywhere between 25 and 10%, just as a sort of bit of jam tomorrow, as it were, a bit of enjoying the upside when it happens. So we're certainly seeing that. I think with pure M&A disposals, so selling to a trade buyer or to a PE house, well, particularly trade buyers, we're finding that less so, but that's just my personal experience.
Yeah, I'm seeing a little bit of it, but probably not an excessive amount compared to pre-lockdown.
Yeah.
And you're right in terms of employee ownership trusts. We're finding they're much more prevalent now. But really, sort of people are getting into understanding what they are and what they can do as a really quite, for the right type of business, a really quite attractive exit route.
Definitely. I thought we might move on a little bit and really talk about sort of the process, and in particular how what's how a deal actually is transacted, well, in 2021, but in particular, I suppose, at the moment with all the restrictions and in the lockdown. And I thought it'd be useful if we can actually talk about the processes involved and what we're finding and how deals are actually transacted at the moment.
Sure. Okay. Shall I? I'll take that and sort of just take the whole process of a deal once the commercial deal has been reached. So Emma, if you could just give me the next slide, please. What I'll do is just run through the process. So get to a commercial deal. Normally one would document that deal in a heads of terms, which would cover the key commercial points. Not necessarily needed because the heads of terms would be non-binding, except for a couple of clauses which might be giving the buyer some exclusivity to allow it to expend time and money without the danger of someone else coming in and pipping the buyer at the post, or confidentiality. But normally one would have a confidentiality agreement already in place by this stage. And but they are a good measure of making sure that everyone's understood the terms of the deal at that stage. Then it's really getting on to due diligence in earnest, and I think Dan will come back to that on our next slide as we talk through some of the challenges of the pandemic on due diligence. And at the same time as due diligence is starting, that's when the sale documentation generally starts to roll. Buyer would normally prepare the main document, which would be the sale and purchase agreement, either for shares or business and assets, depending on the structure of the deal that is agreed between everyone. And really, that's the document which deals with the commercial deal, documents that out, price, etc., and also is the risk allocation document. Who takes what risk in a transaction which, if one took all the documentation away, it would be caveat emptor, buyer beware. And it's interesting to sort of see whether, there are any thoughts we might have, Dan, on this, and how a buyer would look at some protection within the SPA. Normally, you'd have a combination of what I would call the legal protections, warranties, indemnities, and I'll come on to those in a moment. But there's also financial protections, such as having an earn-out as instead of paying everything up front, and completion accounts or locked box. Can you maybe just take that, and then I'll come back on the legal ones?
Sure, thank you. I think there's 2 points really. First of all, in terms of just general financial structure, if you like, on deals, we're seeing less and less everything paid up front. We're seeing a lot more retentions than we ever used to, some cash being either deferred or at least held back for potential claims, which you're going to come on and talk about, potential warranty and indemnity claims. So that certainly seems to be a theme, that there's less and less 100% cash on completion. We thought we'd see a lot more earnouts. Earnouts are where there's conditional consideration. In other words, part of the price will depend on the future performance of the target business. And we thought we'd see a lot of that because there'd be more divergent views between the buyer and the seller as to what the business is actually worth. And personally, we're surprised that we actually haven't seen so many earnouts. They can be messy, they can be tricky to agree upon, of course, but we're surprised that we haven't seen so many, actually. Before I talk about the other half of that answer, I don't know, Richard, are you experiencing a similar thing, or have you seen a lot of earnouts recently?
I've seen earnouts recently, but again, I don't think particularly more than I would have seen beforehand, to be honest. Most of the deals I'm involved in have some form of deferred, I would say.
Interesting. The other half of your answer, if you like, is what protection is there, really for both parties, actually, from a financial point of view, and that really comes on to the adjustment to the consideration. The buyer wants to make sure that the seller hasn't sort of stripped the balance sheet clean just before they complete the deal, and they get there finding that there's nothing left. And obviously, the same, but the opposite from the seller's point of view. They want to be paid for all the profits up until the time that they've sold the company. So it's traditional to adjust the agreed price based on the actual balance sheet. Let's say it could be net assets, it could be working capital, it depends, but on some financial metric of the business on the date of completion. That's very standard, nothing's changed there. What we have found quite a lot is that there's been quite a bit more of a move towards, well, first of all, actually seeing a bit more lockbox rather than completion accounts. In other words, that's where the economic interest has passed at a date prior to completion, so that everyone can determine exactly how much is payable based on a date that's typically a couple of months before completion, and that way everyone knows exactly what the adjustment will be on completion. The buyer knows how big a check they need to write. But the other thing we're finding is there's been a lot more arguments over what constitutes cash and debt. Typically on any deal, cash and debt will be added, or cash added, debt subtracted to the price, and then there might be some other adjustment based on working capital or net assets or whatever. And we've seen a lot of arguments that we never used to have over cash. And to give one example, we're selling a business where they collect some of their sales go through Stripe, who collect payments on behalf of their client, our client in this case, via credit card or however it's paid, and they always pay it on to their customer within 7 days. Now, on all the deals we've ever done, Stripe accounts have always been included as cash, whereas now we're finding in this one, the buyer is absolutely adamant that it's a trade debtor like any other debtor because it's cash that hasn't yet been received. I never thought we'd hear that argument, but here we are. So I think what we are finding is there's a definite change in people's views on certain financial metrics within a deal, which, as I said previously, didn't happen.
I think inevitably there's a lot more sensitivity around people when they're looking at those sort of things, almost looking for the real difficulties that might come out of this. It's the situation that we're all in at the moment, and I would say from a protection point of view in the agreement, when one looks at warranties and indemnities, things like the furlough arrangements that the target might have taken advantage of are looked at very carefully, and certainly a buyer would want warranties in relation to furlough, but may want to go further than that if it can't determine accurately or adequately how the target has actually approached furlough, how it's documented it, what its reasons for furloughing people are, because I think there's a quite a strong view that once we move out of this, then that's an area which HMRC are going to have a look at very, very carefully to make sure that people have operated it correctly. And in terms of that documentation, it's be looking, it'll link in things like corporate governance, which obviously is quite dry, and when one's doing deals in the SME sector, asking for minutes of directors often of directors meetings often leads to a very practical minded seller raising eyebrows, and really, well, here's one that we prepared when we were incorporated. I'm exaggerating slightly, Daniel, but that there's a little bit of that, but documenting thought process on things like furlough is really important. And
yeah, I think furlough in itself is very interesting. In fact, not just the furlough scheme, but also things like bounce back loans and whatever. The government are aware of the fact that there is allegedly a lot of abuse and potentially fraud in people claiming from the job retention scheme and claiming bounce back loans that they weren't entitled to. So I think any buyer is going to be, as you say, is going to look through that very carefully. They're certainly not going to want to acquire an asset which is where there's been some fraudulent activity previously. From a financial perspective, it's actually quite interesting where the target company is in receipt of furlough grants, job retention scheme money, as to whether that would be something which adjusts the normalised earnings of that company. And we've actually sort of taken different views depending on the situation. Sometimes where a company has furloughed its staff, but actually nothing much has really changed, we're saying, well, we should add back the income they've received because that's just one-off income that they won't receive again. Whereas sometimes if they've almost effectively shut down part of their operations and their earnings have obviously suffered as a result, which we're saying, well, the income from the furlough scheme is, if you like, replacing the income that they would have earned from the earnings. So it can be looked at in different ways, and we'd always assess each one on its own merit. But certainly from a legal perspective, I entirely endorse everything you're saying, that a buyer does need to be careful.
Yeah, so the coronavirus job retention scheme is you can, it's quite a good, it sort of goes to the heart of the pandemic, doesn't it, and business in terms of how the media and how it's affected people. And so it's quite a good example if I move on to warranties and indemnities. So obviously the key thing in the sale documentation in the SPA are warranties. Those are the main protection that a buyer would get, and a warranty is a statement that something is true, and to the extent that it isn't true, then the person relying on it, the buyer, can claim damages for loss of for the reduction in value of the shares that it's bought if it's a share deal. Now, from a furlough point of view, one could argue that, well, as long as the company has operated furlough effectively, then a warranty protection is sufficient. But if there's any sort of suggestion or allegation, if you like, that it hasn't, then a buyer would almost certainly want to go further and either take a retention if it's really worried about that, retain some of the purchase money, or take an indemnity if it feels that actually this is something that that is going to be a problem. The reason a buyer would want to take an indemnity there is because if one has a warranty in a purchase agreement, the seller has a process called disclosure, and has a disclosure letter sitting alongside the warranties, whereby if it tells the buyer that's about something as to why a warranty might not be true, then to the extent that the buyer has been told, the buyer can't then claim against that warranty. So it's all very well being told that there's a problem, but then the buyer is going to want some redress if a problem arises afterwards, and so it would tend to take an indemnity, which is a pound for pound, essentially in very simple terms, a pound for pound, usually on demand um, obligation on the seller, that if the particular thing comes home to roost, in this case the furlough scheme has not been operated correctly, then the buyer reclaims pound for pound against the seller for what it has lost. I mean, there are obviously other protections within the SPA, restrictive covenants, and as I say, retention as well. So that's the sale documentation, and that's really the process. Moving on then to the completion process once the documentation has been agreed, negotiated, and the parties are ready to go to the final stages. So, Dan, is there anything else on that, or shall we move on to the next slide?
No, I think we can move on.
Sure. So, due diligence. We've talked that in some length, and we've used the furlough as an example of that. I think it's fair to say probably slightly more protracted, probably slightly more considered and more in depth. And as always, be prepared as a seller and plan out what you're doing. Make sure that everything is in order. Make sure that questions can easily be answered. There's nothing worse for a buyer than finding due diligence and information which is poorly ordered, which is incomplete, because guess what? That makes the buyer very suspicious that the company is run in that particular way, and can cause to all sorts of difficulties, really. And I've seen deals fall over for that reason, particularly more so in an environment where people are very cautious.
Yeah, no, I agree with that. I think people are definitely taking longer over due diligence. They're going into more detail, more depth than they ever used to, because they really do want to find out everything that they need to find out about the asset that they're buying. We're seeing a little bit more vendor due diligence, where people who are about to sell a company actually commission their own due diligence so that they know what, if anything, needs to be corrected, if you like, before they go to market, and you know, they know exactly what questions the buyer's then going to be asking once they do their own due diligence. So yeah, it absolutely, from a financial perspective, it's happening, but you know, with greater scrutiny than it ever did. And I assume, Richard, you're seeing the same from a legal perspective.
Yeah, absolutely. And if there was any suggestion that people would continue to do paper due diligence and exchange of bundles, I think this has finally killed that off. And the use of what I would call proper data rooms is almost always, which I see on every deal now, and that's obvious. But again, it enables a seller to properly sort out its information and its documents, order it into indexing in a data room, and then it's much more ordered. So that's almost part of the vendor due diligence up front. It's having to have the discipline of putting the information into the data room.
Definitely. And we actually, I mean, on one hand, we love virtual data rooms. It's very 21st century, as you say. Who wants bundles or files anymore? And it makes it so much easier because everything's there. We can then interrogate the data how we want to interrogate it. It turns up in soft form, so we can interrogate it using the computer, if you like, rather than having to turn pages. The only thing that's slightly sad, I think, is that, you know, you don't have the ability so much now to actually go and visit the target's premises when you're doing due diligence, to go and look in the eyes of the people you're talking to. It's not quite the same on Zoom somehow. So that, you know, that human interaction's gone a bit, which is a bit of a shame. But no, on the whole, you know, it's taken too long, but we're finally there in terms of due diligence being transacted in the 21st century.
Yeah. I think that again, as we said both of us a couple of times on this talk already that that meeting face to face is really important, and I think data room or not, I think that's still a thing that should be done. I mean, it's not just legal and financial due diligence, is it? Because one of the things that I've been thinking about in this pandemic is the difficulties that people working have had, you know, whatever their circumstances, that this has been very challenging time. And you know, in some circumstances, depending on the type of business, I think it might also be worth doing a bit more due diligence in other ways. You know, HR due diligence on you know, surveying staff and understanding how people are coping with it. Because if you're buying a people business, which is really dependent upon the motivation and drive of people, you know, that's absolutely crucial, and there are ways and means in which you can get into that sort of due diligence as well.
No, absolutely, and we're seeing. I mean, there's a lot of areas of due diligence which picked up. You mentioned HR, absolutely. Pension due diligence has been quite a bit of. Not so much the deals we've been involved in personally, but environmental due diligence is a big thing now, particularly with, you know, the country's aim of being carbon neutral by 2050 or whatever it is. And even management due diligence. So on some larger deals, you do find that they do these sort of psychometric analysis on the management team and that kind of stuff. So
Yeah,
yeah, it's certainly, the scope has widened a lot.
yeah. And so I think 2021 specific, it's obviously mentioned furlough again, corporate governance around that, health and safety with the issues with premises, supply chains, customer base, and Brexit obviously comes into this as well, doesn't it? One of the things that lots of people saying in particular types of good into Europe now will need is to appoint an authorised representative in Europe to be able to sell direct into the EU, and you know, that's again the sort of thing that that comes out of due diligence and understanding the supply chains and the customer base.
Yeah. So once due diligence is sort of finished and the buyer's happy and everyone's ready to complete the deal, then what are we finding at the moment? Some of the practicalities of completing deals obviously have to change. In the old days, it'd typically be a completion meeting where everyone would gather in an office. There'd be 20 copies of every document that everyone would sign. There'd be sort of, you know, an Amazon rainforest sized
Yes, all
bundle of
right. No.
paper.
Okay, leave lawyers alone. It's not all our fault.
But things have obviously changed. So how's you know, how deals been completed now?
Yeah, I mean, taking the next stage, actually. Sorry, next slide, please, Emma. Taking my the deal I mentioned in the summer as a prime example of that. It would have been fairly heavy on calls or virtual meetings anyway, because it involves Singapore and the States as well as the UK. But you know, there was no meeting physically at all of the parties, and it was all conducted through virtual meetings. And I think, I mean, this is just common sense and practicality, but it's, you know, being aware of how more difficult in different ways it is to have a virtual meeting, and respecting people to be able to give their points of view properly within that. And there's actually that sort of human behavior thing. You know, if someone dominates it, then that can create actually quite a negative impact, because what you don't have is the after meeting and the pre-meeting niceties that we human beings are so used to having, and where actually a lot of that that relationship building actually happens, and that gets lost in virtual meetings. So I think actually you should make it in those, depending on the particular meeting. You know, if it was a very hardcore negotiation, you know, at a particular point in the transaction, then maybe it's not appropriate. But I think there is time for small talk and finding ways to do that. If it's a complicated big deal, looking at platforms which enable a bit more interaction between the target and the buyer, in terms of having, you know, maybe something like Hopin, where you might have a main stage and then breakout rooms for different teams to meet, for example. So I think all of those things should be considered quite carefully. And, you know, fine for a presentation, but not too many people on a call, because again, you know, the whole thing gets lost really. And as you quite rightly picked me up for being on mute earlier, just trying to work a meeting properly, and that was a prime example of how not to do it. So apologies again to everyone for that. But equally, being on mute when you're in a large meeting and not having, you know, the kids making noise behind, or you know, someone clattering in the kitchen. So yeah, that's just some personal thoughts on that really, but it all comes down to human behavior.
Yeah.
I
What
think.
about actually sort of signing bits of paper and all that?
So yeah, I mean, that's in many ways we've got a long way down the line on that, because the in-person completion meeting was, to be frank, less and less now, and lawyers tend to get paper moving by email and an exchange, or an electronic platform, and so in a sense that hasn't changed too much, but it's effectively just made it almost rather like paper due diligence. It's made it the absolute norm, and you know, I don't think there's really going to be much going back. It's interesting because one might say, well, use a platform such as DocuSign, which, you know, works very nicely. But I did a deal before the lockdown actually, where yes, in theory it works, but it took an awful long time to get the documentation loaded and to go round. And rather than everyone just signing it at one point in time, it had to make its way around actually quite a few signatories. And so we had that combination of some clients in our office, some people from of the people from the other side, and we were sitting for hours waiting for that to go round. That's not me saying I don't believe in those platforms, but there are limitations, and one of the key limitations in terms of signing electronically is deeds, and that's quite difficult, because one has to a deed has to be witnessed, and it's quite evidential as to how that needs to be done. You can't, for example, witness someone over a television or a virtual meeting. So if you were signing a document there, Dan, I couldn't witness your. I could witness it, but I couldn't legally witness your signature. It'd have to be someone there with you. And again, social distancing and lockdowns makes that difficult. Lawyers, I think it's just inbuilt in us to make a witness as independent as possible. So, you know, the advice was always, you know, no one in your family, never a child. Actually, there's nothing in law to say that that it can't be someone who is a member of your family. There's nothing to say that there's no apparent prohibition against a minor acting as a witness, but the difficulty is evidence, because if one has to interrogate whether it was signed properly, then obviously it's difficult with a child. And also, if you've got someone very closely connected with someone, again, someone might argue that, well, that wasn't done properly because it was in their interests to, you know, to do it. In my wife's interest for me to sign a document, or my interests, you know, vice versa. So so there are issues with that. The other issues that continue, there's what I loosely call the Mercury issues, and Mercury was a case which basically said that what you can't do is have a deed and get someone to sign the last page of the deed and then attach it to the finally negotiated document. And I still see problems with this, you know, from quite respectable law firms sometimes, and often tends to be quite late at night. Well, when all corporate lawyers love doing deals, and and clients have lost the will to live, but actually have to be very careful on that, so that what we have is what we call a Mercury compliant email that goes back, which requires someone to reply with the document and with the signature page attached, which confirms that is the version that they have actually signed.
Yeah, I'm conscious we need to leave a bit of time at the end for questions, but I think it is also worth talking about once the agreement has been signed, whether it's by DocuSign or paper or some other media, then what in terms of it? You know, various things need to be deposited with Companies House, with the stamping office. What are we finding is
So
happening?
I think one of the most refreshing things of this whole thing is that some entities like the stamp office have you know, come up to date very fast. So you had to provide a wet ink signature on a stock transfer form, for example, before that could be adjudicated and stamped. Not at the moment. The electronic versions will suffice. And so there's just a lot more reality. And I think, like a lot of our businesses, we've dragged ourselves probably several years into the future, really, in terms of how we're operating remotely, etc. And I think the same for those sorts of bodies. The coronavirus emergency regulations, people might be aware of those in reality, because essentially that they have allowed electronic meetings, members meetings. So if you had a deal where you had to have a members meeting, then you don't have to do that, as the articles say. 2 or 3 or 4 people in person together, you can do that electronically. And I've been involved in an AGM recently, which was in direct prohibition of the articles, were it not for the coronavirus emergency regulations. And Companies House have extended their filing deadlines for accounts, confirmation statements, and the other event-driven forms.
Yeah, that's right. I mean, annual accounts now have 12 months at the moment this year, whereas typically for private companies it's 9 months. So yeah, they have been extended. And just going back to the stamping office you mentioned, I mean, as you say, it's our experience as well. It's very 21st century now. It's all done electronically. I think because they're no longer affixing stamps to paper documents, I wonder if they're going to have to change their name and find a new name, because they don't stamp anymore.
The Electronic Affixing Authority, yes, the EAA.
Indeed.
Okay, well, I think that brings us to the end of our trot through what we wanted to say, Dan. So should we take some questions?
Great, thanks both. So we've had a question that came in overnight, so I will start with that one. So how do you begin to put a valuation on your business generally, not specifically in relation to the pandemic?
I think I'll tackle that one. So there's various ways that businesses can be valued, and different methods can include an earnings-based valuation. If you're talking about a minority interest in a business, there might be a dividend yield valuation. If a business is asset heavy, there might be some kind of net asset based valuation. Certainly more mature, not mature, that's not the right word, but certainly larger businesses where there can be more certainty of future earnings, there'll be a fully discounted cash flow based valuation. So there are lots of different techniques that valuers use. I think for SMEs, which is sort of what we deal in, as I said before, we typically deal in deals 1 to 50 million. It is pretty common that it would be on some multiple of earnings, typically EBITDA, which is earnings for interest, tax, depreciation, amortization, and applied to multiple. That in itself is a mathematical discount, shorthand, if you like, from doing a fully discounted cash flow. I won't sort of bore everyone now how, but that's typically the most common. Most common is a multiple of EBITDA. I just as an aside, I did notice someone put in chat something about EBITDAC, which is EBITDA before coronavirus, and the point there is, are we seeing further adjustments because of coronavirus? I think the answer to that is yes, but the way it's happening is when people use an EBITDA multiple to value a business, it's not just going to be what's EBITDA on last year's accounts. They're going to try and assess the underlying or normalized EBITDA behind the figures. So some of the figures might not be at arm's length, such as directors' earnings if it's an owner managed business. So it's always going to be adjusting the figures in the accounts anyway to an underlying or normalized EBITDA. And during the pandemic, if EBITDA itself is affected, then there'll be an adjustment to the EBITDA. If you want to call it EBITDAC, so be it. But that's how we're seeing that. Yes.
Great, thanks for that, Daniel. And another question we've got: why do you think deal flow remained constant even in a pandemic?
We've probably both got something to.
Yeah. I mean, I think partly because of the technology that we have, partly because once people got over the initial shock, unless you're in one of the sectors which unfortunately is very badly hit just because of footfall and people being out and about. Businesses have continued, and so my cloud computer example in the summer, that very busy, and therefore that's that's just continued. And I think we've got a thriving startup sector within VWV, and I know, Dan, you guys do that as well. Hugely busy in terms of people having new ideas and people wanting to put their money into it. So I think Dan used the phrase, people got a lot of dry powder. I think that's a driving reason. People want to do that, and yields elsewhere are very hard to get anything decent in terms of a yield with your money.
Yeah, I agree with all of that. I think even more basic, there are some deals are going through because people are still retiring or people are still falling ill or whatever it is. So there's always those sorts of lifestyle type changes that people go through in their lifetimes, that those deals are always going to happen. We've already spoken about the dry powder. I won't go through that again. And I think the other side is there's a demand for particular industries at the moment. Obviously, we've said things like retail and travel are obviously not very attractive at the moment, but things like technology in particular are obviously very attractive at the moment, and there's a lot of demand to acquire assets in these sort of, dare I say, sexier industries before prices do go too high, particularly for a sort of earlier stage company. I'm not talking about a startup, but something that hasn't yet reached maturity. A potential buyer might think now is a really good time to buy it before it does get too expensive. So I think the demand's always been there. So for all kinds of reasons, deal flow has remained. I'm not sure if it's necessarily quite constant, as you said in the question, but it's certainly there.
Great, thanks both. It's another question we've had in. Someone's saying that they've managed to close an investment from a British strategic investor in August, in the middle of the pandemic. What's your view on investing in startups in 2021? Will investors sit on the fence, or will they be opening their wallets? If yes, what sectors primarily?
From my perspective, it's everything that we've really just said. That I mean, yes, absolutely. The first part of the question is, will investors open their wallets and will they invest in startups? I think yes, very much they will. I don't see investors sitting on the fence. And it depends on the type of investor, of course. But if we're talking about a family office or a private equity house, they're the ones with the dry powder. Some angel investors might have been burnt a bit through the pandemic and might not have so much cash lying around to invest, but people are fed up of getting limited or no returns on cash or bonds, and therefore do want something more exciting to put their investments to work on. So the demand is still there. Startups, we're in this very entrepreneurial environment. Obviously it's not just Silicon Valley or even Silicon Roundabout in London, but the UK is an entrepreneurial environment. Certainly at the moment with business asset disposal relief. Let's see what happens in the budget. So there are lots of startups happening, and we're seeing that people are still keen to invest in them. And in terms of sectors, it comes back to really what I said in my previous answer. It's technology is the obvious big one. Anything that's really disruptive. So another obvious example in sort of looking at stock exchanges worldwide is things like Tesla or NIO in China, the Chinese equivalent of driverless cars and whatever. Anything that's really disruptive and that's going to move things more towards the 21st century are probably the hot areas.
I'd agree with that, Dan. And we do a lot of work in the pharma and life sciences sector, and there's a lot of excitement around med tech. There's a lot of excitement around life sciences onto genomics and those areas. Really, lots and lots of interest.
Great, thanks both. And about the real estate market, what's your forecast? Will it crash? This person is particularly interested in the Scottish market with a focus on Glasgow.
Okay, well, as a Celt, as a Welshman, I can probably not help at all, but I can't predict that. I think all I can say is just generically, it's just a personal view that the way we're all working now in the big cities and the CBDs of the big cities, I think it's going to be challenging as a landlord because of the way people working, people giving up floors and spaces and buildings and working in a different way. So I think that's going to have an effect. And yeah, probably in Glasgow, but you know, I'm not a real estate expert. Actually, perversely, in some of the places nearer where people live, maybe people will relocate offices to smaller towns, and that might make it stand up quite well. Those are not the real estate expert views. They're just sort of trying to apply a bit of logic and common sense to it.
Yeah, just very briefly, I'm also not a real estate expert. I think there's obviously going to be a big difference in residential and commercial. So whilst residential is overpriced, there's nothing saying at the moment that that's going to crash. I think even within commercial, I think it's very important to distinguish between office space on the one hand, retail space on another hand, and even retail, there's a big distinction between high street retail and say shopping mall retail. And then on another hand, how many hands have any of us got, is things like other commercial spaces, so things like factories, warehouses, where the demand for that will definitely remain. But I think things like central London office space is probably going to potentially be a threat. And I don't know much about the Scottish market, but I could probably assume that Glasgow might follow that, but to a lesser extent. And I endorse what you say, Rich. I mean, you know, I know you've got an office in Watford, we've got one in Finchley, and I think those sorts of areas, commercial, the commercial demand probably will, where office demand will stay up, and probably less so in central London. People won't want to commute so much anymore.